So what I'm hearing more and more of these days is talk of this impending complete market and economic meltdown. And it's almost as if with each passing day, we're getting closer and closer to this ominous event. And so eventually what will just happen overnight is that our investments and our assets are just going to evaporate into thin air. Now, while I don't dispute the fact that our economy has real problems, I would challenge anybody with that mentality to think of a time when investing was perfectly safe and the economy just had no problems whatsoever. Now, to overcome this perceived dilemma, what a lot of investors are doing is they are basically trading their stocks, mutual funds, and ETFs weekly, sometimes even daily. And there's actually a name for this type of investing or this approach to investing in the financial industry, and it's called speculation. And those that engage in it, historically speaking, do very poorly compared to their counterparts that take on more of a buy and hold strategy over time. I'll talk about why that might be in a moment, but first let's start with stock market story time. So the first decade of the new millennium, starting with the year 2000 and ending on the last day of 2009, was aptly named the lost decade. Now this is because whatever gains were created in the first 8 years of that decade were basically wiped out by the 2008 Great Recession. Some of you might remember that. So essentially creating a net zero gain for the entire decade by the end of 2009. Now, not all investments did poorly that decade. Ken Hebner is a mutual fund manager and was managing the fund CGM Focus Fund for that decade. And his fund actually produced 18% annual gains year over year on average between 2000 and the end of 2009. He was named by Morningstar as the fund manager of the decade. Now, what rate of return do you think that the average investor that participated in Ken Hebner's mutual fund during that decade, the best performing mutual fund, what return do you think the average investor got? If you guessed negative 11%, which I'm sure nobody did, you'd be correct. And that sounds incredible, believe me, it sounded that way to me the first time I heard that. And you might be wondering, how could that be? The short answer is emotion. The average investor participating in his fund didn't stick around long enough to recognize any of those gains. In fact, a bunch of people jumped in at the 2007 peak when they saw that his fund was doing so well and they wanted a piece of the action. Less than 12 months later, after the Great Recession, their gains had been completely wiped out. In fact, they bought in very expensively and then they sold their shares very cheaply, netting themselves negative returns. So why am I telling you this story? They say that history has a way of repeating itself, and I don't think that could be more true than in stock market history. The biggest problem with trying to time the market is that you have to be right twice, when you buy and when you sell. And most mutual fund managers aren't even successful at that, which speaks to the statistic that less than 15% of mutual fund managers outperform the S&P 500 index on a year-to-year basis. So, in conclusion, if you're waiting for the perfect time to jump in the market when there's no issues and the economy is operating perfectly, then I just want you to know you might be waiting a really long time. Are we going to see more market pullbacks and volatility? Absolutely. It's guaranteed, but it's always been that way. There's never been a safe time to invest. Reward has always been tied to risk. And the more risk that you take, the more reward that you are able to get. And that's not true just of stock market investing. That's true about any type of investment. Now, if you're one of these investors that's buying and selling stocks and mutual funds on a weekly or daily, even monthly basis, remember the story of the lost decade. And my recommendation would be to pick out a diversified combination of whatever you want, mutual funds, ETFs, throw in some individual stocks too. but find some funds that have a good track record of performance over a long time, over at least 10 years, maybe 15 years, and stick with them and see what happens. I think that you'll drastically lower the stress levels in your life, and if you hang out in those positions for the next couple of decades, I'm pretty certain, I can't guarantee anything, I'm pretty certain that you will be much more satisfied with the results than if you just continue to buy and sell like it's going out of style. Now, if you're one of these people that has no idea what I'm talking about right now, then you need to be reaching out to your financial advisor. If you don't have an advisor, find somebody that you trust and work with them and have them educate you and teach you the principles of investing that I'm talking about here. In conclusion, just remember that making smart investment decisions doesn't mean you always avoid the hard times. It just means that you overcome them. I'm Matthew Holt with Christian Wealth Management. I appreciate you watching. If you liked this video, if you got something out of it, hit the like button, share it with a friend, and I look forward to connecting with you next time. Blessings.